$100 silver in China. Western vaults are being emptied to feed the East. Right now, while the COMEX screen shows $74, Chinese factories are paying $100, a $25 gap. The largest arbitrage opportunity in 40 years. Every bar, every ounce, is being loaded onto planes, London vaults emptying, Zurich storage depleted, New York inventories collapsing. The professional trading world doesn't call this a spread anymore. They call it a broken market. Western banks are trapped, short 500 million ounces at prices that no longer exist. And the East is setting a new price. The question isn't if the US price will hit 100. The question is, what happens when the vaults run completely dry? Welcome to Financial Announcement. If you've been watching markets long enough to remember when information actually meant something, you're in the right place. We'd appreciate it if you'd hit that subscribe button, the same way you'd bookmark a page worth returning to. And to drop a comment below, let us know where you're watching from today. New York, London, Mumbai, or somewhere the real price discovery is actually happening. Now, let's break down what's really going on. The screens in New York are lying, not intentionally, but systemically. Every trader staring at the COMEX silver price sees $74.59. They see green candles. They see movement. They see what appears to be a functioning market. But 5,000 miles to the east, a completely different reality exists. In Shanghai, in Shenzhen, in the industrial zones where silver is actually consumed, the price is $100 per ounce. Not officially, not on any exchange screen. But in the real world, where factories need metal and citizens need wealth preservation, that is what people are paying. This is not a premium. This is not a temporary fluctuation. This is a broken market. Professional commodity traders have a rule. When the physical price in one major market diverges from the paper price in another by more than 5%, something is structurally wrong. When that divergence reaches 33%, the market is no longer functioning as designed. The $25 gap between New York and Shanghai represents the largest disconnect in modern silver trading history. To understand why this matters, one must first understand the difference between paper and physical. In New York, the COMEX trades silver futures. These are contracts, promises, legal agreements that allow one party to buy silver at a specific price on a specific date. 95% of these contracts are settled in cash. No metal changes hands. It is purely financial engineering. The system works as long as everyone believes there is enough silver available to fulfill delivery requests if needed. But belief is not reality. In China, the market operates differently. Solar panel manufacturers need silver paste to build photovoltaic cells. Electric vehicle companies need silver contacts for battery management systems. Telecommunications firms need silver for 5G infrastructure. These companies do not want contracts. They want atoms. And when millions of industrial buyers compete for a limited supply of physical atoms, the price disconnects from paper promises. The reports coming from Shanghai are striking. The official Shanghai Gold Exchange lists silver around $78. But that is the futures price, the benchmark, the number that gets published in financial media, the street price, the price that dealers and refiners are actually charging for immediate delivery, has exploded. Industrial buyers in Shenzhen are paying close to $100 for silver bars today. Not tomorrow, not next month. Today. This proves something critical. The inventory is gone. When the price of a commodity rises $25 above the global benchmark in a single geographic region, it signals a localized famine. Supply has collapsed. Demand remains constant, and buyers are willing to pay any price to keep factory lines running. China is starving for silver. The Chinese solar industry produces 85% of the world's solar panels. The government has mandated 400 gigawatts of new solar capacity annually through 2030. Each gigawatt requires approximately 30 tons of silver. That is 12,000 tons per year, just for solar. Add electric vehicle production, add electronics manufacturing, add 5G build-out, add retail investment demand from a growing middle class seeking inflation protection. The total annual requirement exceeds 18,000 tons. China's domestic silver mines produce only 3,500 tons per year. The 14,500 ton deficit must be imported at any price. This creates a profound problem for Western financial institutions. The major banks in New York and London are short silver. They have sold futures contracts representing 500 million ounces, betting that the price would remain suppressed, but the physical metal is fleeing westward. Every day, bars are withdrawn from London vaults. Every week, Swiss refiners ship tons to Hong Kong. Every month, COMEX registered inventories decline. The banks cannot cover their short positions because the metal they need to buy is disappearing onto cargo planes headed east. They are trying to suppress a beach ball underwater, while a giant magnet pulls it upward from above. The mathematics are simple. If silver costs $74 in New York and $100 in Shanghai, every rational dealer will buy in New York and sell in Shanghai. Shipping costs 50 cents per ounce. Insurance costs 30 cents. Total overhead, less than $1. Net profit, $25 per ounce. This is not speculation. This is arbitrage, risk-free profit. And it will continue until one of two things happens. Either the Shanghai price falls or the New York price rises. Given that Chinese industrial demand cannot decline, and given that Western inventories are already depleted by 40% year over year, there's only one mathematical outcome. The New York price must rise to $100, not because of speculation, not because of hype, because water finds its level, and right now, the level is 100. There is a phenomenon in physics called equilibrium pressure. When two chambers contain the same gas at different pressures, and a valve opens between them, the gas flows from high pressure to low pressure. It flows rapidly, it flows violently, and it does not stop flowing until pressure equalizes. The global silver market has just opened that valve, and what is flowing through it is every available ounce of physical metal in the Western Hemisphere. This is not theory. This is happening right now. The mechanism is breathtakingly simple. The profits are staggering, and the consequences for Western inventory levels are catastrophic. Here is how the trade works. A bullion dealer in London wakes up on Monday morning. He checks the COMEX silver price, $74 per ounce. He checks his Shanghai contacts, $100 per ounce for immediate delivery. He does the calculation in his head. Buy 1,000 ounces in London at $74,000. Loaded onto a cargo flight to Hong Kong. Insurance costs $300. Freight costs $200. Customs and handling at another $200. Total cost, $74,700. Land in Shanghai on Wednesday. Deliver to a refiner or industrial buyer paying spot plus premium. Sell for $100,000. Net profit in 72 hours, $25,300 on a single shipment. This is not a sophisticated trade. This is not complex financial engineering. This is buy low, sell high at its most primitive level. And it is completely risk-free. There is no counterparty risk. There is no price volatility risk during transit. There is no regulatory uncertainty. The metal is real. The demand is real. The profit is guaranteed. Professional traders have a term for this type of opportunity. They call it an infinite money glitch. So what happens when this trade becomes widely known? When every bullion dealer on the planet realizes they can make 25% profit in 3 days by simply moving metal from west to east, they do exactly that. And they do it at scale. The numbers are staggering. In January alone, Swiss customs data showed 1,200 tons of silver exported to Asia. That is double the historical average. London vault withdrawals hit record levels. COMEX registered inventories. The silver actually available for delivery dropped from 250 million ounces to 150 million ounces in 6 months. 40% depletion in half a year. The vaults are being systematically emptied. But here is where the story becomes more than just an arbitrage trade. Here is where it becomes a structural crisis. The Western banking system is built on a fundamental assumption. That assumption is that physical silver will always be available when needed, that paper contracts can always be converted to metal if a buyer requests delivery. For 40 years, that assumption held true. 95% of futures contracts were settled in cash. Only 5% ever requested physical delivery. The banks kept enough inventory in vaults to cover that 5%, with a small buffer. But the buffer is gone, and delivery requests are rising. In February, delivery notices on COMEX silver contracts increased 300% year over year. Industrial buyers are no longer accepting cash settlement. They want the metal, because they know what the dealers know. If you settle in cash at $74, you still need to buy physical silver in the real world. And in the real world, it costs $100. So they demand delivery from COMEX, they take the bars, and they immediately flip them to Chinese buyers for a $25 profit. The arbitrage is not just happening at the dealer level, it is happening at every level of the market. Refiners in Switzerland are prioritizing Asian contracts over Western contracts. Why refine a bar for a New York client at $74 when a Shanghai client will pay $100? Miners are diverting production. Why sell to a London vault when a Hong Kong vault pays more? Every participant in the supply chain has made the same calculation. The profit is in the East. The metal follows the profit. Western banks are now caught in what game theorists call a prisoner's dilemma. They are short 500 million ounces of paper silver at prices between $20 and $30 per ounce. They sold these contracts years ago, betting that silver would remain cheap and that physical delivery would remain rare. Both bets are failing simultaneously. If they try to cover their short positions by buying physical silver, they drive the New York price higher, which increases their losses on existing positions. If they do nothing, the physical metal continues flowing east, which eventually empties the vaults, which means they cannot fulfill delivery obligations, which triggers default. If they default, The entire COMEX silver market loses credibility. Industrial buyers panic. The price gap's even wider. There's no winning move. The only question is which form of crisis arrives first, price explosion or delivery default. Meanwhile, the cargo planes keep flying every 24 hours. Another shipment leaves Zurich. Another vault withdrawal processes in London. Another delivery notice gets filed in New York. The metal is moving at a pace never seen before in commodity history. And every ounce that leaves tightens the noose around the paper market, because eventually the vaults will be empty. And when the vaults are empty, the New York price will have no choice but to close the gap. Not gradually, not over months, violently. The $25 vacuum is pulling everything eastward, and the West is about to discover what happens when paper promises meet physical reality. There is a concept in supply chain management called non-negotiable demand. It refers to inputs that cannot be reduced, cannot be substituted, and cannot be delayed without catastrophic consequences. Silver has just entered that category for China. Not because of speculation, not because of investment mania, but because the entire architecture of China's industrial future is built on a foundation of silver atoms, and those atoms are running out. This is not a story about commodity trading anymore. This is a story about what happens when the second largest economy on Earth realizes it cannot function without a metal it does not produce. Start with solar panels. The average person does not think about silver when they see a solar installation on a rooftop. They see glass, they see blue cells, they see clean energy. But inside each photovoltaic cell, there's a network of silver paste connecting the silicon wafers. That paste conducts electricity with 99% efficiency. No other element matches that performance at scale. Scientists have tried copper. The efficiency drops to 78%. They have tried aluminum. It corrodes too quickly. They have tried graphene compounds. Too expensive for mass production. Silver is irreplaceable. And China produces 85% of the world's solar panels. The government mandate is clear. 400 gigawatts of new solar capacity every year through 2030. That is not a suggestion. That is national policy tied to carbon neutrality goals and energy independence. Each gigawatt requires 30 tons of silver. 400 gigawatts requires 12,000 tons annually, just for solar. Now add electric vehicles. The Western media talks about China's EV industry in terms of market share and competition with Tesla, but they miss the underlying material reality. Every electric vehicle contains between 25 and 50 grams of silver. Not in the batteries, not in the motors, but in the electrical contacts that manage power distribution between battery cells and control systems. Those contacts must handle high current loads without degrading. They must resist oxidation for 15 years. They must maintain conductivity across temperature ranges from minus 40 to plus 80 degrees Celsius. Only silver meets those specifications. China's EV production target for 2025 is 12 million vehicles. Conservative estimates suggest 15 million by 2027. At 40 grams per vehicle, that is 600 tons of silver per year. And this is just passenger vehicles. Add commercial trucks, add buses. Add two-wheeled electric scooters that number in the tens of millions. The number climbs toward 1,000 tons annually. Then there is 5G infrastructure. The build-out that Western nations talk about as a future possibility, China is executing today. 5 million base stations are already operational. The target is 8 million by 2028. Each base station contains silver-plated contacts and antenna arrays. Each relay node uses silver in circuit boards. Each fiber optic junction box contains silver-based switches. The telecommunications industry is not transparent about exact material requirements, but industry analysts estimate that the 5G build-out alone consumes 1,500 tons of silver per year in China. Add consumer electronics, add medical devices, add industrial sensors for smart city projects. The total annual industrial consumption in China exceeds 18,000 tons. Now here is the problem. China's domestic silver production is 3,500 tons per year. The deficit is 14,500 tons. That deficit must be imported every single year, without exception. This is not a cyclical demand pattern that rises and falls with economic conditions. This is structural demand embedded in multi-decade infrastructure projects that cannot be canceled or postponed. The Chinese government has spent $2 trillion building the solar supply chain. They have committed $1 trillion to EV industry development. They have allocated $500 billion to 5G expansion. These are not speculative investments. These are strategic commitments to technological independence and economic transformation. And all of them require silver. So when a factory manager in Shenzhen needs silver paste to keep his solar panel production line running, he does not care if the COMEX price is $74 or $100. He cares that the line keeps running. Because if the line stops, the factory misses delivery deadlines. If the factory misses deadlines, it loses contracts. If it loses contracts, workers get laid off. If workers get laid off in sufficient numbers, social instability rises. The Chinese government does not tolerate supply chain disruptions that threaten social stability, so the factory manager pays $100. The EV manufacturer in Guangzhou pays $100. The telecommunications contractor in Beijing pays $100. Price sensitivity has disappeared, and this is what economists call perfectly inelastic demand. The quantity demanded does not decrease when price increases, because there is no alternative. And this creates a feedback loop that terrifies Western commodity analysts. As the price rises, Chinese industrial buyers do not reduce consumption. They simply pay more. As they pay more, it becomes more profitable to ship Western inventory eastward. As Western inventory depletes, the New York price must eventually rise to match Shanghai. When the New York price rises, Chinese buyers still do not reduce consumption. They pay the new higher price. And the cycle continues. There is no natural ceiling to this process. The ceiling is wherever Chinese industrial demand can no longer be physically satisfied. Not financially satisfied, physically satisfied. And right now, that ceiling is nowhere in sight. But there is another dimension to this story that amplifies the crisis. Chinese retail investors have entered the market. For decades, the Chinese middle class stored wealth in real estate. Then the property bubble collapsed. They tried stocks. The equity markets proved volatile and politically manipulated. They tried savings accounts. Inflation eroded returns. Now they are buying silver, not as speculation, as wealth preservation. The cultural memory of currency debasement runs deep in China. The hyperinflation of the 1940s, the economic chaos of the Cultural Revolution, the more recent yuan devaluation pressures. Physical metal represents something the government cannot print, cannot seize easily, and cannot devalue overnight. Retail silver demand in China has increased 400% in 3 years. The Shanghai Gold Exchange reports that individual investors are now purchasing 2,000 tons of silver annually for personal holdings, 2,000 tons that are removed from industrial supply, 2,000 tons that sit in private safes and safety deposit boxes, 2,000 tons that will never return to the market. Add industrial demand of 18,000 tons. Total annual requirement, 20,000 tons. Global mine production, 25,000 tons. China needs 80% of global production, and they are willing to pay whatever it costs to get it. Because the alternative is not financial loss. The alternative is industrial collapse. There is a moment in every financial crisis when the architects of the system realize they have built a trap for themselves. A moment when the mathematical elegance of their derivative structures, the sophisticated hedging models, the decades of successful price management, all collapse into a single horrifying realization. They are on the wrong side of physics. That moment has arrived for the Western banking system. Not loudly, not publicly, but in the private risk management meetings happening in London and New York, the conversations have shifted from confident management to crisis containment because the banks are short, catastrophically short. The exact numbers are deliberately obscured. Proprietary trading positions are not disclosed to the public, but commodity analysts who track market structure have pieced together the magnitude. The major Western banks, JP Morgan, HSBC, Scotiabank, and several others, hold short positions in COMEX silver futures representing approximately 500 million ounces. 500 million ounces. At current prices, that is a notional value of $37 billion. But here is the critical detail that most analysts miss. These positions were not opened at $74 per ounce. They were opened over the past 15 years at average prices between $18 and $30 per ounce. The banks were betting on silver remaining cheap. They were betting on demand remaining stable. They were betting that the paper market could continue functioning independently of physical reality. All three bets are failing. If the price moves to $100, and these positions must be closed, the banks face unrealized losses exceeding $35 billion. That is not a rounding error. That is a balance sheet event. But the losses are only part of the problem. The real crisis is mechanical. To understand the trap, one must understand how the COMEX system was designed. And it worked perfectly for 40 years. The system relies on statistical certainty. Historically, 95% of silver futures contracts settle in cash. Only 5% request physical delivery. So if a bank sells 100 million ounces in paper contracts, they only need 5 million ounces in vault inventory to cover potential deliveries. The leverage ratio is 20-1. And for decades, it worked flawlessly. But the statistics are breaking down. Delivery requests have surged 300% year over year. Industrial buyers are demanding physical metal. Arbitrage traders are demanding physical metal to ship to China. Even retail investors are standing for delivery. The 5% assumption is now 12% and climbing. This creates an impossible equation. If 100 million ounces of paper contracts suddenly demand delivery at 12% rates, the banks need 12 million ounces of physical silver, but they only have 5 million ounces in registered inventory. The 7 million ounce gap cannot be purchased in the open market without driving the price vertical. because every ounce they buy to cover deliveries removes one more ounce from available supply, which increases delivery pressure on remaining contracts. It is a death spiral. Game theorists call this a coordination failure with no Nash equilibrium. There is no move any individual bank can make that improves their position without worsening the collective situation. If Bank A tries to cover its shorts by buying physical silver, the price spikes. Bank B and Bank C face larger losses, so they rush to cover their positions. The price spikes further. More delivery requests flood in. The very act of defending against the crisis accelerates it. Some analysts have suggested the banks could simply declare force majeure, invoke contract clauses that allow cash settlement when physical delivery becomes impossible. But that triggers a different kind of crisis. The moment COMEX announces it cannot fulfill delivery obligations. Every industrial buyer in the world loses confidence in the exchange. They stop using futures for hedging. They demand physical purchases only. The premium over paper prices explodes, not $25, not $50, but multiples. And the banks still hold massive short positions that must eventually be closed. Force majeure does not solve the problem. It announces the problem publicly. There is another dimension to this trap that few outsiders understand. The London Bullion Market Association, the LBMA, operates on an unallocated system. When a client deposits silver into an LBMA vault, they do not receive specific bars with serial numbers. They receive a digital ledger entry representing ounces. The bank promises those ounces exist, but multiple clients can hold claims on the same physical ounces. It is fractional reserve banking applied to precious metals, and it works perfectly until clients want their metal back simultaneously. Right now, withdrawal requests from LBMA vaults are running at levels never seen outside of financial crises. Clients are asking for allocated storage. They want specific bars with specific serial numbers in specific vault locations. The banks are struggling to fulfill these requests because in many cases, the bars do not exist, or they exist, but they are already pledged to 3 different clients through the unallocated system. The emperor has no clothes, the vaults have no silver, and everyone is starting to notice. Regulatory pressure is mounting from an unexpected direction. Basel III, the International Banking Regulation Framework, now classifies physical gold as a Tier 1 asset. Paper gold is Tier 3. The rules for silver have not been formalized yet, but the implication is clear. Physical metal carries less balance sheet risk than paper claims. Banks are quietly shifting from unallocated to allocated positions. They are withdrawing metal from the LBMA pool to back their own balance sheets. This removes supply from the system, which tightens availability, which drives premiums higher. The regulatory solution to banking instability is creating commodity instability. So the banks face 3 impossible choices. Option 1, cover their short positions at $100 per ounce, realize $35 billion in losses. Explain to shareholders why decades of profitable silver trading ended in catastrophic failure. Option 2, default on delivery obligations, trigger a crisis of confidence in commodity exchanges. Watch the physical premium gap to paper markets widen to $50, $70, $100 per ounce. Option 3, request emergency intervention from regulators, suspend silver trading, impose position limits retroactively, force cash settlement on existing contracts. This option preserves bank solvency in the short term, but it destroys market credibility permanently. It signals that paper contracts are worthless when inconvenient. It drives every sophisticated buyer exclusively into physical markets. All 3 options lead to the same destination, a silver price well above $100 per ounce. The only question is which path of destruction gets chosen. Meanwhile, the vaults continue emptying, the arbitrage continues flowing, the Chinese factories continue buying, and the Western banking system continues pretending that $74 is the real price. But physics does not negotiate with financial engineering. Water finds its level, pressure equalizes, and when the valve opened between New York and Shanghai, the direction of flow was set. Everything is moving east, and the West is about to learn a lesson it has not confronted in 40 years. Physical reality always wins.